Today we're talking about pizza. I brought candy, so y'all might have to start clapping.
Whoa.
That's all we first. We can't start. Let's go. Next one. Alright, so I'm gonna give an intro, background information. Maya's gonna talk about the beta and the WAC. Jose is gonna explain our pro forma. Mike's gonna talk about the DCF model. Amelia is gonna explain our dividend discount model. And Fatima is gonna talk about the market multiple method. And then I'm gonna wrap it up. Alright, so go ahead. Oh wait, don't ask me, I'm talking about the background. Right. Okay, so Visa was founded in 1958 in Fresno, California. Currently, they're the largest electronic payment network. They hold the majority market share of 51%, and it's a growth stock right now. And today's closing price was $181.36. Go ahead.
So we started off by calculating an estimate of Visa's beta. For this part, we used 3 years of data. We used the company's closing stock prices together with the S&P 500, which served as our benchmark. We then ran a regression analysis of the week-over-week percentage change, and we found that Visa's beta is 0.94. Because the beta is less than 1, this means that the stock is less volatile than the market. So in a recession, the stock would be considered less risky and would likely be less impacted than the general market. After we calculated beta, we used this to find the weighted average cost of capital. We used the capital asset pricing model, also known as CAPM, in order to find the cost of equity. We used the yield of a 10-year T-bond as our risk-free rate, and the 30-year return on S&P 500, which served as the average expected return on the market. We found that the cost of equity is 9.59%. For the cost of debt, we used the average yield on Visa's 3 outstanding bonds with a maturity of over 5 years. We concluded that the after-tax cost of debt for the company is 2.14%. We then calculated the weights of debt and equity, which you can see is about 52% debt and 48% equity. Finally, with all of this information, we reached the value of Visa's WACC, which is 5.7%. And now over to Jose, who is going to talk about our performance.
Good evening, everyone. This financial statement closes on September 30th, 2019. So therefore, we use the past 5 years of financial information to build our pro forma, which is from 2020 to 2024. The growth rate for estimated that we estimated is 20.01%, and this growth rate is based on the retained earnings. We use earning retention model to calculate it. In addition, we did some operating assumptions based on the revenue projections. These revenue projections we used to determine the forecast year of 2020 to 2014 on the operating accounts and also on the interest-bearing accounts. Visa revenue growth is expected to gradually decrease 3% at the end of the forecasted years, and the result of our forecast determined that Visa has an excess cash with over 70% of retained earnings. Therefore, Visa is able to support their growth and finance new projects without use of debt. Now I pass it on to Michael, who is going to explain the discount model.
Okay, so I'm going to go over the DCF model real quick. So we started by calculating the free cash flow 5 years ahead. So we used the EBI-AT, the depreciation and accounts payable. That is added on because it is actually like cash that Visa gains, for the amount that Visa gains. We deducted the accounts receivable and capital expenditures because that is pretty much the amount that Visa pays out, and it's not a part of our free cash flow. So pretty much CapEx, capital expenditures we got it by using the increase in by using the increase in value of the net property, plant, and equipment. And next, we use the WACC calculation that Maya talked about with for the free cash flow to get the present value. So since Visa is growing at about 20% per year, we couldn't use that since it's not gonna always grow at 20%, like for the rest of its life. So we used a 3% terminal growth because that is the inflation rate, the historical inflation rate. And so using the discounted cash flow model, we came up with the intrinsic value of $268.86 per share. That's what we calculated. And next, I'm going to give it to Amelia to talk about the next model.
I'm going to talk about the dividend discount model. We use the annual non-constant growth rate to calculate, and the WACC to calculate estimated value of future dividends. And then we found the present value, and then we summed it to sum that value to determine the net present value. And the horizon value of the stock was found to be $147.12, and the NPV of the stock's dividends was found to be $105.89. We also assessed the value of Visa's common stock across A, B, and C of Visa's common stock. And this includes the quarterly payable amounts over 10 years, which is from 2009 to 2019. We also found each period's the annual growth rate for each class of stock from zero growth rate to 5-year growth rate for each class. And we also assessed for these as Class A common stock, and we found its WACC growth rate and terminal growth and yearly decline. And we found the WACC to be 5.63%, its growth rate to be 20.83%, its terminal growth to be 3%, and its yearly decline to be 8%.
Okay, we're going to use Canada. So we first want to discuss about Visa's competitors. Because of the business model with Visa, any transactions between a seller and a buyer, Visa is competitive. But because of the reporting purposes, they listed MasterCard, American Express, JCB, Discover Club, that now is Discover. So first, with JCB, it's a closed-held company, so we don't have access to the reporting. But Visa sees as a main competitor because they want to expand their business in Japan, since Japan has the third largest economy in the world. Also, they're sponsoring the Olympics for Tokyo 2020, so they're going to be with them. We're gonna go over the next slide. So the first, just to follow Visa reporting with the competitors, we did the industry averages. We took the information, we first took the information from Seeking Alpha. We using PE with the gap, they have two gap and non-gap, so we chose to go with that because the most generic that is available. We have market book value, the price cash flow. One of the flow with this method is that MasterCard and Visa are leading the market. And the second one is that in order for this to be functioning, it has to be the same industry. Visa and MasterCard, the industry is data processing, the sector is information technology. For American Express and Discover, the industry is consumer finances, and the sector is financial. So this is not accurate for our purposes. Now we're gonna go over the market multiple methods. So we single out MasterCard as the only comparator to Visa. Using MasterCard information available, we came out with differential prices. As you can see, referring to a BE, we have 207. Using price, the price factor is 669, and the highest level is 919. In the real world, there is no unethical business, so this is not as accurate as we pretend it to be. Now we're gonna pass it back to Manfred, who's gonna finish the presentation.
So
So basically, the discount dividend model was not really relevant after we did it, and the market multiplier range was a little too wide. So that's why the DCF model we chose was the most accurate. And, so since it's currently trading at 181 and it's worth 263, we're saying, the best thing you could do right now is go buy Visa. Thank you.
No questions from the students?
What was the reason you thought the dividend discount model wasn't relevant?
Well, Visa as a company, they retain most of their earnings, so 70% goes, or more than 70% goes to retained earnings, which means that they're a growth stock, so it's not like the best model to use because they don't pay that much dividends.
Anybody else? Please.
Can you like show again how you calculated the growth rate? You say you use retained earnings or how exactly?
Yeah, we actually use the earning retention model, which uses the payout ratio and multiplied by the return on equity. And since Visa, its growth is based on retention of earnings, we decided this is the best way to calculate the growth.
I'm sorry, you said you, I caught part of that. You did what again?
We use the earning retention model or flow back ratio
All right.
to determine the growth.
So would you use net income? Explain the
payout
model to me
ratio.
real quick. Just explain it to me.
Yeah, the formula is 1 minus payout ratio multiplied by return on earnings, and that's.
Return on equity.
I'm sorry.
Okay, that's what's going on. Okay, cool. No other questions? More time for me, huh?
This is a suggestion. Why was WAC and some of the other calculations from the dividend discount model relevant to the dividend?
Say that again?
So there were some variables on the dividend discount model that when, well, I recall, calculating dividend discounts, you really need dividend growth rate and, let me see, return on equity. So what is WAC, how does WAC relate back to that?
If I'm not mistaken, we need WAC to forecast with future cash flow or for forecasting for the next 5 years.
To
And then you
discount
have
it
the
back to
percentage.
present value.
So you have that percentage of earnings that are paid out and then retained, and then you just multiply that. Is that what I'm saying?
For this dividend discount, we did use like the largest, formula to find the growth rate. So that's why it's not the same growth rate as for the performance, because we're determining two different growths. So the dividend growth is not the exactly same as the revenue growth, but then we use the WACC to discount it back to present value to find the earnings for the short.
What is EBIAT? Earnings before interest after tax. Okay, and we got that from Lisa's financial, yeah, the investor relations or financial statements.
If anybody else has a question?
All right, go to, slide 4. By the way, good job. First of all, let me back up. Good job. All right, one. Two is, you numbered your slides, which is good. So that's that. Slide 4, I said, right? Give me a second, I'm sorry, I'm just making a mess here. All right, why'd you decide to calculate a beta?
Why?
Why? Why'd you decide to calculate your own beta instead of using one that you got from a website?
We can't trust them. We gotta do it ourselves.
What website did you use for your data?
We use Seeking Alpha, we use the.
What do they have for beta?
The three bar. Well, actually, Seeking Alpha didn't have the beta.
Okay, so where'd you get your beta from? Or where'd you compare, where did you look to say that you disagree with the market beta or whatever, and you decide to calculate your own, or you just decide to calculate your own?
If I'm not mistaken, there's another website that we didn't know it was so trustful, so we didn't decide to go with it. It was still under one. Some websites even say the data was 0, so we didn't think that was right.
So then, why'd you go 3 years back and weekly?
We felt like daily would have like a little bit too much noise, and then monthly would be a little bit too long of a period, so that's why we decided to take like a middle, and then 3 years because we wanted enough data. So it would give us like 250 values to run the regression on.
All right. Next slide. Who did this, most of this work? Huh?
Yeah.
How'd you calculate your weights?
For debt and equity, we took the total debt and then the total equity, and then.
What'd you use for equity?
We got it from the income statement. I mean from the balance sheet.
Because it's wrong. How'd you calculate weights, especially for equity?
For equity, we use,
Just say market cap. That's what you're supposed to use. Publicly traded market cap. Visa's not carrying that much debt. So two things, your weights are off, and your weights are off, and that means your WACC is actually way too low. I don't have it in front of me, I don't remember right now, but Visa's debt to equity rate is a lot higher than equity. So you're gonna be close to that 9.5%. So your WACC's off, which means your valuation is off too. Price of stock is actually too high based on that.
If we compare to like some of the websites, Seeking Alpha, some of the other ones, and they had roughly similar, like 50-50.
Yeah, because they're using the balance sheet. You guys are supposed to use what? Market value. I told you market value, I'll allow you to use the balance sheet for the book value for the debt, but that's the market cap for the equity. So your weights are off. They're way off. All right, boom, boom, boom. How'd you calculate your before tax cost of debt?
We took they had 3 bonds with the long maturity, so we took the average of the yield of those bonds.
Average what?
Average yield.
Yield to maturity or coupon?
Yield to maturity, not coupon.
All right, I'll check. It seems low. That's the reason why I asked.
I think in the Excel, it has the coupons next to it, so you can compare the coupon rate and the actual.
No, not, it's always yield to maturity. It's not coupon, it's yield to maturity.
No, and I'm saying in our Excel sheet, we have both of them, so you can compare it.
Oh, I'll check it. Thank you. All right, let's move on to the pro forma. Next slide. All right, so you got 5 years growth rate, 5 years financial statements. Growth rate 20%. You calculated, and by the way, that growth rate 20% is what? Is that revenue, earnings? What is that growth rate for?
revenues.
For year 1,
For year 1.
and then it's gradually decreasing to.
And that's the formula you use, return on equity times retention ratio,
We did the average on
which you realize that's the growth rate for earnings, not revenue. Right? Return on equity, right, times retention is the growth rate for earnings, not for revenue. That's why if you look at last year's revenue grew at 11%, you jumped from 11% to 20%. So my question again would be, where'd you get that growth rate from, and how'd you get 20%?
Well, the average growth was 13% over the 5 years.
Historical.
Yeah, historical.
All right.
Also, since they're really close to fiscal year on the transcript, they mentioned that the company has potential to grow, but because they're not saying that economics, but they think that the economy will slow down and that will affect them, that's what they plainly say, keeping them 2011, even though the company has potential to grow.
So therefore, that means that 20% really is out of place, based on what you just told me too.
Looking at ideal scenario,
We didn't
Can
take into
predict
account
it.
the recession.
You're missing my point. There's no way that Visa's going from 11% to 20% unless you see some other revenue driver, something going on that you haven't told us that you see.
well, they have many positions coming up. Rambus, I think, is one of them. It's a token verification that will help them to expand on the market, not just in the United States, but outside. So they see their customers as a potential customers and also compete with other small, like Venmo or like Zelle, it's already in the market. So they're just trying to
So
expand
I gotta clean you up a little bit.
Okay.
So you tell me about potential acquisitions.
No,
No,
they already
it's
closed
already
it, they're waiting.
They close the deals.
Yes,
When they close them.
that one was closed in October, November. If there was the last week of October or the first week of November.
So you're saying that the company they acquire is gonna take revenue growth from 11% to 20%.
Well, they're forecasting it for 2020, because they were talking about the fiscal year 19,
Yes.
and they were talking.
Because they gotta
about 2020.
digest it, and they gotta break it up, and they gotta take all that. So it's not gonna show up in the revenue stream for probably a year, 2 years. So again, I ask you, how do you get the 20% growth rate? So the answer really is, what?
We'll fix it. It's fine.
We'll fix it. It's not growing at 20%.
Okay.
All right, that's what it really boils down to. All right, all right. Next slide. So I had the same question, EBIAT. What is it? What does it mean to me? What'd you swap out to put that in? Earnings before interest, but after tax?
No, amortization.
I'm sorry? What's EBIT mean? EBIAT, what is that?
No, that was
It's right there in the slide. What is it?
I think we swapped it to.
Huh?
Might be a typo.
Yeah.
Might be.
No, it's not a typo, because I heard somebody else ask the same question, and you guys answered it. Didn't somebody ask this question already?
Yeah, we didn't realize we had a typo.
We
on
think
there.
it's earnings before tax and amortization, but that might, you tell it. Is that wrong?
That'd be EBITDA.
Typo. So we talk about the same thing though, I think.
All right, the EBIT, so, something's going on there.
We'll double check that.
Who did this slide? Don't say all of us. Somebody, who put those bullet points up there?
You know the team. I touched slide up.
So what, I understand, you said calculated free cash flow 5 years ahead.
Yeah.
All right, why do you have the bullet points, EBIT, depreciation, accounts payable, and accounts receivable and CapEx? I'm trying to figure out what the purpose is there.
Well, it's to use it so we calculate the free cash flow for each year.
So those are your assumptions?
Those.
Those are what you use to calculate?
Yeah, it's not. Yeah, it's what we. Part of it.
All right. Then you have used WACC and free cash flow. So let me clarify this for your classmates. If you're gonna actually explain, talk about your models, we already know what goes into the model, right? So what do we need to see? Assumptions, the numbers. So what is your WAC? What are the growth rates you used? I see you have terminal down there. Leave it now.
Okay. We have it on the Excel, so.
I'm just telling you what you gave us. All right, so we need to know, like in your paper too, we already know how to calculate discounted cash flow. All right, so what I need to know is what assumptions, and that's the reason why I asked about EBIAT. I never seen that before, so I'm going, now what is that? Like, maybe you found something that I don't, I wish I knew everything, but I don't. So you might be doing something that I haven't seen before, and that's why I asked the question. During your presentation and even in your paper, I got stuck on that. I was trying to figure out what that was. You follow?
Yeah.
So this should be your assumptions, so that any one of us sitting here right now could actually look at that and say, wait a minute, I disagree with what you used for a risk-free rate. I disagree with what you did this, or I agree. So, and then the other thing too is you have your final intrinsic value. Is that a discount or premium to where the stock's currently trading?
That's a premium.
How much?
Well, we subtracted by the 181.
Like
You get my point now?
Yeah.
We don't know if it's a discount or premium. We don't know how much of a discount or premium it is. So you're telling me that based on your numbers, this thing's trading at like almost a 50% discount. Now, just off the top of my head, I'm gonna say that's probably wrong, but then that also goes to the fact that your WAC is so low. So I imagine if you change your WAC, that number's gonna come down dramatically.
What's the growth rate?
And then what's your terminal growth rate?
Terminal 3%. But our
So,
growth
okay,
rate
you got
is-
terminal 3%, you drop that WAC down, I can almost guarantee you're gonna come down a lot more than from the 263. But again, you should be giving us your assumptions. We already know, like you have that current growth. What is the current growth? Is that making sense? All right, next slide. All right, this is a question for the class, not for you guys. Keep your mouth closed. Class, when this slide popped up, if you were looking, did you stop listening and start looking at this, trying to figure out what all this stuff meant?
Yes.
No, we weren't listening.
No, I'm saying, I mean, you're all being polite, but I'm saying, when you looked at that slide, were you confused? Did you stop listening? And I don't mean that you weren't paying attention, but you stopped listening and you started trying to figure out what that was, right?
Yes.
That means it's really a bad slide. Now, if you put that up there, it needs to be explained. So the first thing that, I'm looking at this, and the first thing I'm going is, again, this is just Milligan. What is a Horizon Value NPV? What actually is that? I've never heard of that term.
I chose a simple format, but I was meaning to explain it in person, but I didn't focus so much on writing it down, but rather explain in person. So what questions do you want to ask?
What is Horizon Value NPV?
Okay, so we estimate the value of future dividends, including the horizon value, which is the value when the growth goes from non-constant to constant. And you use both of those values of estimated dividends and price value to determine.
So that's Horizon Value. It's not Horizon Value net present value.
No, it's not. They're not this.
Right.
Maybe that was my mistake, and I could have made it look better.
All right, so again, I'm going back to another model, right? In essence, everyone in this class knows how to calculate discounted cash flow. So the question now becomes, what assumptions did you use? What's your cost of equity? What's your cost of equity? What growth rates did you have in the dividends? What was the terminal value you used? And then you finally came up with maybe it's on the next slide. No, it's not. And then you came up with a stock price. It's not even up here. And then how's that stock price compared to the current price of the stock? So for Class A, you gave me WAC, growth rate, terminal growth, and decline. You gave me that, but there's no numbers there. We need numbers. Again, we're your peers. We're not, this is not, we're peers. The other thing that came up here is we have common stock dividend, Class A, Class B, Class C. Are there 3 different dividends being paid out?
Yeah, but we only use class A.
So what's the difference? So obvious, you put that up there. The first question that comes up is, what's the difference in the 3 classes? So
One of the class C is convertible preferred.
So Class C is a convertible common stock? Then
Well, it's
again,
from the preferred to common stock.
Class C is, one more time, is what?
It's a convertible bond, convertible stock.
Convertible common stock.
It's a preferred.
So, boom.
They list it as
Ho,
a
ho, ho,
common.
ho, ho, listen to
Yeah.
me. Boom, move it out. It's not even part of this discussion. What's class B?
It's, common stock, but you can only sell it to someone that already has stock in the company.
Insider stock.
Yeah.
Boom, remove it. Shouldn't even be up here. There's only one class of common stock that we need for the average person, and that's class A, and that's the one that you should be working with.
Well, that's the only one we did the model.
Yeah, but why'd you even bother putting class B and class C up there? To confuse us. You follow me?
Yeah.
It's irrelevant information for valuation. That's all I'm saying. All right, and by the way, what are you said the quarterly dividends payable 2009 to 2019, is that the years you did?
I will clarify if I didn't make it clear initially, is quarterly, like every 4 months, there was a value of the dividend from 2009 to 2019.
But why is that there? What are we doing with that? Is that, I'm confused.
It's what the Visa has to pay as a payable as dividends for Class A, B, and C of common stock.
Did you use that in the model at all, that information?
Yes. We took the quarterly dividends and, looked at the growth rate for the last 10 years.
So basically you ran a regression on the quarterly dividends?
And we did the largest.
Yeah, okay, so but you figured out the growth rate based on historical dividends?
Yes.
All right, that's what we need to know.
Yeah.
You follow me?
Yeah.
All right, next. Why am I looking at this?
You said next.
Huh?
You said next.
Yeah, I'm saying, why am I looking at this? I'm asking a
You
question.
said the make comparison for Visa, so then for the market.
So, I'm pause here for a minute.
Yeah.
I'm gonna ask the class again. Class, when this came up, how many of you actually were listening and how many of you actually kind of put listening to the side and actually tried to read the screen and read what was up there and trying to figure out what it was and interpret it? Be honest.
I think the chart.
I'm not saying the chart's wrong, you're not hearing me.
No, I know.
How many of you stopped listening and started reading?
I think the chart's not too bad. I was slow listening.
I was too, actually.
I was listening, I wasn't looking at the chart, I was like, I don't know what that is.
All right? So my question for you, what was the purpose behind this chart?
To demonstrate how Visa and MasterCard was in the high end and the other one was in the low end of the market share.
So it kind of explains why we chose MasterCard as the main competitor and not like an average of the industry.
All right.
Solid.
Yeah, all right.